Central banks set interest rates, you know that, but here's the question that doesn't get asked enough. Set them relative to what? There is a theoretical interest rate, economists call it the neutral rate or R star, at which the economy runs at full capacity, inflation stays at target, and the central bank is doing absolutely nothing to help or hinder. It's the Goldilocks rate, not too hot, not too cold, just right. The problem is that nobody can see it. It can't be looked up, it can only be estimated, and the estimates change every year. And yet every major interest rate decision in Canada, the US, the UK, and Europe is made with this invisible number as the reference point. Today on the Daily Brief Weekend Edition, we build it from the ground up. What it is, where it comes from, how it gets measured, and then, as a live case study, exactly where Canada sits inside it right now, with a rate decision just 10 days away. The neutral rate. What is it? Well, simply, the neutral rate is the interest rate at which monetary policy is doing nothing, neither stimulating the economy nor restraining it. The concept was first described by a Swedish economist named Knut Wicksell in 1898. He called it the natural rate. Modern central banks call it the neutral rate, or R star. The concept is identical. The rate consistent with a balanced economy running at full capacity with inflation at target. Think of it this way, below R star, borrowing is artificially cheap, spending is encouraged, the economy is being pushed forward deliberately or not. This is what central banks do in a recession. Above R star, borrowing is expensive, demand cools, investment slows. The central bank is actively applying the brakes, and this is what fighting inflation looks like. At R star, the central bank is neutral. The economy grows at its natural pace. Inflation sits at target. Nobody is being helped or hurt by the rate itself. Simple enough in theory. Here's the catch. R star is unobservable in real time. You can only know where neutral was, never exactly where it is right now. Think of the economy as a car on a long hill of unknown grade. The neutral rate is the exact throttle position that keeps your speed constant. Not climbing, not slowing. The problem is you don't know the grade of the hill. You're estimating it from the behavior of the car. That's monetary policy. And R star isn't fixed. It drifts over decades in response to structural forces. Population aging pushes it down. Older populations save more and invest less, which reduces the price of capital. Productivity growth pushes it up. Stronger returns on investment pull the neutral rate higher. Capital flows matter too. When the world is awash in savings, neutral rates fall everywhere simultaneously. In the 1980s, neutral was high. It fell through the 1990s and 2000s. Post-pandemic, it appears to have risen again. Same concept, different number, depending entirely on the structural conditions of the moment. Now, this begs the question, if you can't observe the neutral rate directly, how do central banks estimate it? Well, the answer is they run models. Multiple models, in fact, simultaneously, each starting from different assumptions about what drives the long-run balance of the economy. The output is never a single number, it's always a range, and that range is the honest answer, not just a hedge. The first type of model focuses on demographics. An aging population saves more and invests less. The imbalance pushes the neutral rate down over time. Japan is the extreme case, decades of near-zero neutral rates driven almost entirely by an aging, high-saving population. The second type focuses on productivity. Higher productivity means stronger returns on investment, which pulls neutral upward. Right now, the key variable is AI adoption. Its effect on long-run productivity, and therefore on R star, is genuinely uncertain and actively debated inside every major central bank. The third type looks at global capital flows. Neutral rates don't exist in isolation. The global savings glut of the 2000s pushed neutral rates down across all advanced economies simultaneously. That dynamic is now partially reversing as large fiscal deficits compete for global capital. The fourth type extracts signals from bond markets directly. What long-run rate investors are actually pricing into government debt across different maturities. Markets don't always agree with the models. That gap is itself informative. Here's what makes this permanently difficult. R star is defined by the state of a balanced economy, which is itself unobservable in real time. Every model is estimating a moving target using data that is always at least 1 quarter old. The range you get across models isn't a failure of methodology. It's the methodology being honest of its limitations. The post-pandemic period made this lesson impossible to ignore. For roughly a decade, 2010 through 2021, Central banks held rates near zero and called it appropriate. The models said neutral was low. The data seemed to confirm it. Inflation was below target, growth was modest, nothing was obviously wrong. Then inflation hit 8% globally. The upward revision came fast. A decade of apparently neutral policy may have actually been stimulative the entire time. Nobody's models caught it in real time. That's not a criticism of the models, it's the honest limit of the concept. Well, now you have the concept and the measurement problem. Let's take a look at Canada. The Bank of Canada publishes its neutral rate estimate annually. It runs multiple models and reports a range. The 2025 assessment landed at 2.25 to 3.25%, the same range as 2024. Both years showed upward pressure from AI productivity expectations and higher global rates, offset by Canada's specific headwinds, slowing population growth from reduced immigration targets and persistently weak business investment per quarter. The midpoint of the range is 2.75%. That is where the Governing Council implicitly anchors its thinking. And the current policy rate, 2.25%, sits exactly at the floor of that range, 50 basis points below the midpoint. The bank's own April deliberations describe that position precisely: the stimulative end of the neutral range, not neutral, the stimulative end of neutral. Now here's where it gets interesting. The same rate reads completely different depending on where you think neutral actually sits within that range. If neutral is 2.25%, the floor, then the bank is already there. Holding is the correct policy. Any hike would be a deliberate tightening, and this is the bank's own floor case scenario. If neutral is 3.25%, the ceiling, well then the bank is a full percentage point below its own framework. Money is still cheap, inflation risk remains elevated. Holding too long risks embedding expectations above target again. Neither reading is wrong. This is the neutral rate problem playing out in real time. The same number, the same economy, two completely legitimate policy conclusions because the reference point itself is a range, not a fixed value. The Governing Council knows this. Their April statement didn't claim they had found neutral. They said they're at the stimulative end of the neutral range. That is a precise and honest description of an imprecise situation, which is exactly what the framework is designed to produce. However, in recent days, the two-sided risk has shifted. New GDP data confirm Canada is in a technical recession, 3 of the last 4 quarters negative, and the BOC's own 2026 growth target already out of reach. At the same time, core CPI is holding right on the 2% target. That combination raises a pointed question. If the economy is contracting at 2.25%, is that rate actually stimulative, or are we already above neutral without knowing it? The BOC's model says the floor of neutral is 2.25%. The economy is behaving like rates are restrictive. One of them is wrong. June 10th is where the tension gets tested. 3 things to take away from today. First, the range is the answer, not a hedge. When the Bank of Canada publishes 2.25 to 3.25%, that is not a failure to be more precise. It's the honest output of models that genuinely disagree because the underlying reality is genuinely uncertain. Demanding a point estimate would be demanding false confidence. Second, the structural shift matters more than the current number. Neutral rates are higher now than at any point in the last 15 years. That changes the math on mortgages, pension liabilities, corporate debt, and government borrowing. Not just today, but for the decade ahead. That repricing is still in progress. Third, June 10th is a framing device, not just a calendar event. The decision itself may be a hold, but the language around it, where the Governing Council thinks neutral sits, which risks they're worried about, tells you which direction the next move will come from. Watch the statement, not just the number. Every rate decision you've ever seen reported, every mortgage renewal, every bond yield movement, every central bank press conference, all of it is implicitly a bet on where the neutral rate sits. And now you know what that bet is actually about. Well, that's the end of today's episode. Thank you for tuning in to the Canadian Macro Brief Weekend Edition. If this video was useful, please subscribe and hit the notification bell so you don't miss our next brief. And don't be afraid to comment if there's a topic you'd like us to cover in the weeks to come. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different. So please do your own research and speak to a qualified financial advisor before making any investment decisions. Good night.